Most people think investing is about picking the best stocks. It's not. The biggest investing mistake isn't choosing the wrong asset. It's building your strategy in the wrong order. And this single error quietly destroys returns for decades. Today, I'll show you how people accidentally invest backwards and the simple framework that fixes it. Here's how most people invest. Step 1, pick investments. Step 2, hope it works. Step 3, panic during volatility. Step 4, change strategy repeatedly. That feels logical, but it's completely inverted. Because investing success is not driven by individual picks. It's driven by structure. Research across decades of portfolio analysis consistently shows that asset allocation explains the majority of long-term portfolio performance, while security selection plays a much smaller role. Translation: your mix matters more than your picks, yet almost nobody starts there. Markets reward 3 things: time, consistency, risk discipline. Not prediction, not intelligence, not market timing. Consider this. Missing just a handful of the market's best days can drastically reduce long-term returns. And those best days often occur during high volatility, exactly when emotional investors exit. Which means the real enemy of returns isn't bad analysis. It's unstable behavior. Instead of starting with investments, high-functioning investors start with architecture. Here's the correct order. First, define the mission. Second, set risk boundaries. Third, choose allocation. Fourth, select vehicles. Only then do you pick assets. Because investments should serve the system, not define it. Every portfolio has a job: wealth growth, income generation, capital preservation, optionality creation. Without clarity, investors accidentally mix objectives. For example, holding aggressive assets while needing short-term stability. That's not a market problem. That's a design flaw. Your portfolio cannot function properly if its purpose is undefined. Most investors ask, what returns can I get? Professionals ask, what volatility can I survive? Because risk tolerance is not psychological, it's behavioral. It's measured by how you react when markets fall. If a drawdown causes you to abandon your strategy, your allocation is wrong, regardless of expected returns. Sustainable investing requires survivable risk. Allocation is the engine. Growth assets drive compounding. Defensive assets dampen instability. Cash provides optionality. Each plays a role, but random mixtures create random outcomes. Deliberate allocation creates predictable behavior, which is the entire goal. Not maximizing returns, but maximizing consistency of execution. Only after structure is built do individual investments matter. Index funds, ETFs, individual securities, real assets. Vehicles are tools, and tools are useless without design. Perfect investment selection cannot fix a broken portfolio structure, but strong structure tolerates imperfect picks. This approach works because it neutralizes the largest destroyer of wealth: human reaction. Instead of constantly adjusting to markets, you pre-commit to a strategy built for turbulence. Volatility becomes expected, not shocking. Behavior stabilizes. Compounding survives. If your investing feels stressful, confusing, or reactive, you probably didn't make a bad investment decision. You made a sequencing mistake. Stop asking, what should I buy? Start asking, what system am I building? Because winning portfolios are not assembled, they are engineered. If this shifted how you think about investing, like the video and subscribe. Next week, we rotate into credit strategy, where we'll break down how high earners accidentally damage their financial flexibility. See you there, and thanks for watching. The Irregular Income Economy.